Are you expecting a year-end rally?
Well, I think we've had certainly a decent amount of that potentially, whether it carries in. I think positioning might point in that direction. You still have some of the big institutional speculators and hedge funds more on the short side, at least on the S&P. But as we see, particularly on a day like today, every day we're still at the mercy of the data. So I think there are some better breath conditions. Sentiment is not quite as good a setup. We started to see some froth build back in the market, and I think that also contributed to some weakness like today. But I think positioning is probably the strongest support for the remaining, 3 weeks or so in the year.
Still at the mercy of the Fed more than anything else, though, right? I mean, you see the data today was pretty good. It raises concerns that, of course, the Fed is going to be tighter for longer, and maybe that's what was in the market today, too. But that's the whole game still.
That is absolutely the whole game, and we've got the Fed meeting next week, and it will bring with it a new batch of SEP, Summary of Economic Projections, as well as a new dots plot. I wouldn't expect anything terribly wow coming in the statement, but I think the press conference, as always, is going to be interesting, and I wouldn't be surprised if Powell got peppered with not just questions about the terminal rate and timing, but maybe starting to get more questions of what the background conditions would need to be for the Fed to consider going from pause, whenever that might be, to pivot. And I still think there's a bit too much optimism around the time span between pause, whenever that is, and pivot, given that the market has an expectation of 2 rate cuts by the end of 2023. And it's our view that the conditions would have to get a bit more dire than what they are right now for the Fed to see a green light to start cutting rates. And it wouldn't just be inflation continuing to come down. It would have to be more significant weakness either in the broad economy or maybe more importantly, specifically in the labor market.
What would you have to see before saying that a soft landing was more possible? Because, theoretically, as the strategist at Schwab, you'd have to make that call and have a subsequent view of the market long before it was absolutely clear.
I don't think this is a cycle that we might define as simplistically recession versus soft landing. We've been talking about this notion of a rolling recession for many, many months now, and that's just the unique nature of the pandemic. When we're in the stimulus part of the pandemic, and that caused a huge surge in demand, that was at a time where there was no access to services. So all that demand and stimulus funneled into the good side of the economy. That not only represented the lift for the economy coming out, but it was the breeding ground for the inflation problem with which we're still dealing. That has now morphed into recession conditions in many of the goods segments of the economy, certainly recession conditions in housing and things housing related. But we've now, and disinflation, by the way, in many of those categories within metrics like CPI. But now we're in the pent up demand on the services side, the breeding ground for some of the stickier inflation components on the services side. So I continue to think best case scenario is not so much a traditional soft landing, but maybe just a continuation of the rolling nature of this, such that maybe ultimately the NBER doesn't have to come out and say, okay, it was a classic technical recession. Here's when it started. Here's when it ended. I just think this is not a typical cycle. Recessions tend to be everything sort of falls all at once or lands softly all at once. This is happening over an extended period of time in with a rolling nature to it.